Thank you for standing by. At this time, all participants are in the listen-only mode. As a reminder, to submit a question during the call, please click or tap on the Q&A tab on your screen. The information shared during this conference call is provided for educational purposes only and should not be considered an offer of services by Ellevest. This call is being recorded. Let's get things started. Welcome everyone to this month's monthly Market Insights webinar. Happy St. Patrick's Day to all who celebrate. Clearly neither of us on today got too festive with our green. I'm Sara, a wealth advisor here at Ellevest, and I'm happy to be joined by Ankur Patel, Vice President of Investments and all-around market guru.
Oh, thank you so much, Sara. How's it going? I wish I was celebrating St. Patrick's Day with all this news that we've been flooded with over the last couple of weeks. I sure could use a drink right now.
Use some green beer. I know. I know. I'm excited to talk to you, I guess, in what has become the norm, interesting times, interesting month in the markets, in the news cycle, a lot going on, a lot to get into today. So are you ready to dive in?
Absolutely. Let's get to it.
So, if you will, bring us up to date since the Iran war officially started on February 28th. That's the biggest thing that's happened in the last month since our last webinar. It's obviously changing on a daily basis. Can you take us back and just give us an overview of what's happened geopolitically and how has the market reacted or is continuing to react?
Yeah, that's a good way to put it. Continuing to react. It's and you said Feb 28th. It's only been 2 weeks, which is
Wild.
boggling on its own, but let's dive in. So I think what will help us look through this in terms of what's happened in financial markets and the response will be helpful. I think everyone kind of knows the U.S. and Israel attacked Iran about 2 weeks ago, taking out 40 of their top officials in sort of their initial strikes. The response from Iran has been tough. It's been sort of an approach of attacking all the U.S. and Israeli bases that are in the region, in the Middle East and neighboring countries. It's been attacking the ships that have been going through the Strait of Hormuz and sort of threatening to do so. That has been critical in terms of the amount of oil and gas and energy that flows through the strait. It's roughly 20% of the world supply goes through that strait. And so they have decided to, decided to sort of make that a focal point and use that as a point of leverage in sort of retaliation. And that's sort of what we're looking at here. Is everything right now has been driven by the price of oil on a day-to-day basis since the attacks begin. And that is not dissimilar to prior events that we've seen in the past. I think when you look at this chart and you see this sort of line straight up, it's because it's only been 2 weeks. And we've seen this huge climb from $60 to north of $100 a barrel in oil. And you've seen markets, the dark green line here, start to sell off over the last couple of weeks. When you look sort of underneath the hood past oil to see like how our market's reacting, I think it's a little bit more nuanced. Stock markets surprisingly have held up pretty well. I'd say the biggest declines we've seen have been maybe 5% from the recent highs. And if you look at US markets and the S&P 500, it's a little bit more than that, closer to 10% if you're looking outside the US to developed markets or emerging markets. But for the most part, this has been sort of a reaction that's been more muted when compared to other sort of wars in the Middle East that we've seen in past times. I think if you look beyond stocks, bond markets also had more of a tepid response. I think here what was interesting was seeing interest rates go up, not down. Typically, when you have a situation like this, bonds act as a safety net. Interest rates typically go down when there's a flight to safety. In this case, because this was sort of more of an oil shock, interest rates went up, basically noting that, there's an inflationary component, inflationary risk here. If the price of oil is going to stay elevated for some time, that could have repercussions to inflation in the, not too distant future. And so that's why we're seeing sort of a tick up. The 10-year moved up about 30 basis points, but has not gotten well beyond that. So again, a response, but counterintuitive to what you would expect, and more muted, also. And even beyond that, looking at inflation expectations, they've moved up as well, as you would expect with oil going higher. And year to date, again, that puts, most asset classes sort of flat on the year. When looking at how markets have performed, obviously commodities up big because of oil. But I think it all speaks to the fact that, and the one thing that's not being shown here is gold. Gold has actually come down close to 10% since it started. And that's a little bit different than usual as well. I think gold has just been on such a strong rally coming into all of this. Usually gold is going to act as a geopolitical hedge anytime there's flare-ups like this, and that does not seem to be the case. And I think part of that is just the dollar strengthening and interest rates going higher. And part of that is just the fact that it's had such a strong run year to date. But I think a lot of this to me speaks to the fact that financial markets seem to be looking through this, looking past it to some extent, thinking, hey, there is maybe a path to a shorter term resolution, maybe not a long protracted war, which would mean other risks and other things, which we're just not seeing today in financial markets. But that doesn't mean we won't see them. It's just not where we're at today.
Sure. I think what's striking about this slide is that it feels perhaps to investors a lot worse than it has reflected in actual returns in the market, depending on, which asset class you're looking at. Like you said, we're close to flat across the board, but every day feels like there's a lot of turmoil going on. And what you said, and historically what we've seen is that markets show resilience to geopolitical shocks, right? They can look through those major events. So with the daily or the intradaily escalation that we're seeing, kind of the investor sentiment, reacting to that, how should we think about the difference between short-term volatility, the ups and downs of the market we've seen, and longer-term structural risk to global markets?
Yeah, that's a good question, because that's kind of what I think markets are struggling with right now, or investors are struggling with more so. I think markets are pointing to more of a short-term risk at this moment. I think, when you see muted response from financial markets, it typically, means that most investors are expecting this to pass in relatively short order. I think there's been sort of I think just pattern that we've observed over the last, year and a half of this administration, where there's a flare up, there's something that, is going on that's disturbing markets. There's some sort of announcement. Last year we saw it with tariffs. I'd say markets have sold off way less than they responded to when the tariff announcements came out. And I think over time, what people have realized is there is some fluidity to a lot of these decisions that this administration is making. And they are relying on the fact that, we can get out of this situation without oil being elevated for too long. And I think that's the crux of this. I think it becomes a lot more stickier or just more complicated if oil stays elevated for much longer, because that leads to inflation risk, that leads to stagflation risk, that leads to lower global growth. There's one thing for the US to deal with, higher oil, higher gas prices, and a little bit more inflation. It's another for, countries around the world who can't necessarily afford $100 per barrel oil, rely on it heavily. And so there is a risk to sort of globally what this means. I think when you look at longer term pictures, this is a cool chart that shows sort of other conflicts that we can look at to say, hey, what's happened in the past? To me, the ones that come to mind are going to be the Iraq War, and probably the Gulf War, that are probably the most similar here. And what this shows us up top is sort of what happened after these wars. because initially these were also sort of oil shock situations where the price of oil went up, stock markets went down, and then they reverted course afterwards. And you can see here, obviously strong returns after the Gulf War back in the 90s. In 2003, another case for strong returns, but here I'd mention that this was also coming off of the tech bubble and sort of the depths of the tech bubble. So I wouldn't attribute all of this gain to be just, hey, there was a sell-off because of war. Um, this is just to give us an idea of what do longer term returns look like typically. And if you're thinking about, sort of longer term risk, that's where we've seen, the story always tends to go back to the fundamentals and sort of what's driving earnings at the end of the day. It's typically not a foreign war. There is an expense associated, obviously, but typically those are shorter term in nature. And what we've seen is, even in this case, when you think about the price of oil and who it's hurting, it's sort of hurting everyone. And it is, at the end of the day, in everyone's best interest for this to be resolved sooner rather than later. And hopefully it comes to that. I think, over the last couple of days, we've seen markets actually go up, surprisingly. I think there is some hope because there's been some ships that have gotten through the Strait of Hormuz, but I think it's just, hopefully we see more signs of that coming down over the next couple of days to weeks, because that, I think, will give a lot more comfort to financial markets in terms of this not being a longer term issue, which has different risks associated with it.
Yeah. Yeah. Oil's really the star of the show,
Yeah.
for sure right now. So let's stick with that for one more question. You've touched on some of this, but can you break down, for in layman's terms, why is the stock market and the oil market so intertwined? And obviously, as you pointed out, they're moving in opposite directions right now, right? Oil prices have gone up. We've felt that volatility in the markets. Is that always the case? Can we expect that to always be the case, that they move, in opposite directions? And are there sectors that we can think about that, might perform better or worse when oil prices are elevated? Um, let's start there.
Yeah. Yeah. That's, I mean, we have the a perfect chart for this too, in
Yeah.
terms of looking at the relationship. And I'd say it's nuanced and it's not always one way or another. I think the current situation, this being an oil supply shock with an inflation risk attached to it, is an example where you will see the stock market sell off in response to a move like this, where there's a sharp move and there is risk of inflation attached to it. I think there are other times where you could look at a period like COVID.
Mm-hmm.
COVID, we saw a sharp decline in economic activity and GDP growth associated with a sharp decline in oil, right? There, no one was, traveling, moving around. Oil was not needed. Oil sort of suffered along with demand and growth. But then on the other side of COVID, we saw the same trend. We saw an uptick in growth and demand. Stock markets rallied. So did the price of oil. And so if the price of oil is being driven by growth, that you can see a positive correlation to stock markets and the price of oil. If it's being driven by a supply shock like this, you tend to see sort of a negative correlation where stocks move in the other direction. Now, I think when it comes to what sectors benefit, things like that, typically you'll see energy stocks, of course, do well whenever oil is up. In this case, you'll see defense stocks do well in a time like this. Consumer discretionary stocks don't do well. Anything that's tied to inflation risk, I've seen travel stocks get hurt a lot. Airline stocks have gotten hurt a ton over the last couple of weeks. And I think those are sort of some of the more obvious ones. But again, it really depends on the duration of this war, and sort of when looking at underlying sectors and what's doing well, it's sort of a function of the why, like what's driving this price of oil, and not necessarily, and also for how long is typically what we see.
How might the impact on inflation impact the Fed's path for this year?
That's the other wild card right now. I think the Fed
Yeah.
is also meeting over today and tomorrow, and one of the wild cards that this throws into the mix, I think, is the fact that the Fed had made so much good progress on inflation over the last year, hoping to get to its target. Not quite there yet, exactly at 2%. Here we're looking at close to 2.5%. Some readings in the threes still, but I think there's been progress. Now, the prospect of higher oil and the prospect for more inflation is going to sort of give the Fed pause on lowering interest rates in the near future. Um, the challenge to that, though, is the fact that they are also dealing with a jobs picture that has been getting worse. And so, just as a refresher, the Fed has two main objectives: it's price stability and employment. And when you look at the employment picture, it has been trending lower more recently. The last jobs print was actually negative. And so if we didn't have um, this this war right now, if oil prices hadn't skyrocketed, there was an expectation for markets that the Fed might start lowering interest rates soon. And coming into this year, there was still an expectation for maybe another 2 or 3 cuts potentially by the end of the year. If you look at it now, you'll see here prior to this, even the Fed themselves thought they were going to get another at least 50 basis points out lower this year. Markets are saying, hey, not so fast. Now we might only get one more cut by the end of this year. And so that's the challenging part to this is it's sort of how do they balance those two risks of employment and inflation? And they have the scars from the inflation picture over the last couple of years. They do not want to make that policy mistake again. So it's going to be really interesting to see how they handle this situation. I think everyone's thinking they're not going to do anything because, again, this is such a near-term risk. Anything can change day over day that they're not going to be quick to pull any triggers, so to speak. So I think this is something that the markets are going to be paying attention to and over the next couple of months.
Yeah. Sticking on the Fed, we just got a question from the audience on that topic. Do we think that the Fed will change their focus from employment and prices given the new people on the board, given the changes in direction?
Yeah, that's a good question. What we do know is the new Fed governor coming in has a reputation for being more hawkish. Mm-hmm. So that would be sort of pointing towards keeping rates where they are, keeping them higher for longer, not lowering them as quickly. There might be political pressure to do so, but there is a board of governors that decide what happens with interest rates. It's not a single person vote. Mm-hmm. There are many governors that have to vote on this. And so right now, what we've seen over the last year has actually been a more divided Fed than usual. We've seen the data come in. It's been more challenging because there's been sort of spotty data because of the government shutdown. There hasn't been availability of data every single meeting that they would normally have. But at the end of the day, they have also been at odds in terms of what to do with interest rates. Should we lower? Should we not? And that's led to sort of a non-decision along the way in terms of not doing anything. And so I don't think that drastically changes with the new Fed governor that's coming in, but that is a good question. I think for the Fed, it's always going to be a balance between these two objectives. And I think if either of these pictures gets worse than the other in terms of drastically worse, like I think if we see 2 or 3 months of negative job sprints ahead of this and we see inflation sort of stay where it's at, not move too much, I could see the Fed sort of saying, actually, jobs is more important right now, and we need to lower, right? And you could see that, and you could also paint the other picture and say, hey, next 2-3 months, the jobs picture could improve. Maybe there's something there that we're not seeing, and inflation actually, maybe this war continues, maybe oil stays higher for longer, maybe that starts having an impact on inflation, and you could see the Fed say, time out, we're not doing anything until inflation is under control. So you could make a case either way. I think they will always still have to balance those two objectives.
Yeah. It'll be interesting to see how the next couple of days go for them.
Yeah, absolutely. I mean, I think they're kind of stuck, right? Like having a meeting right now without knowing how this is going to play out is going to be impossible for them to make a decision. So I could see why markets are pricing in a non-move, but you're right. It is going to be interesting to see how they talk about it.
Yeah. All right, shifting gears slightly, we can, you can see the volatility in public markets. We've talked about it. You can log in and track what's going on in the S&P and the Dow. What about this crisis's impact on private markets? And let's go into private credit specifically.
Yeah, that's private credit has been in the headlines a lot, and I think that is a story that's sort of been unfolding
Yeah.
since last year. So not necessarily tied to this crisis, but more so just from I think a broader sort of risks to markets that people have been paying attention to more recently, and it's sort of to me one of the bigger things that people are talking about right now is sort of the size of the redemption requests that a lot of these private credit funds are seeing in the markets. And so, for anyone who hasn't been paying attention to this, basically, I'd say the back half of last year, there had been several sort of things that happened within private credit where certain companies either couldn't pay back loans and defaulted, or private credit funds had issues meeting withdrawal requests from investors. And part of what had started this has been the fears around AI that have been driving markets and software stocks down a lot towards late last year, the beginning of this year. They're calling it the SaaS apocalypse, which isn't the best name in the world, but
I heard that.
no. Um, but the idea is that, up to 25% of private credit is invested in software
Yeah.
and tech companies at a smaller size. And if public markets are showing that there could be a big risk, why isn't private credit exposed? And so another quick aside for private credit for anyone, again, who hasn't been following along too closely, private credit is essentially where companies go to borrow money if they can't get money from a bank. And a lot of this sort of started, the rise of private credit really started a lot more after the financial crisis in '08, but has grown to a very, very meaningful size, north of $1 trillion in sort of asset size. So it is a big, big player. Now, more recently, there have been sort of these semi-liquid funds, which are not completely private, not completely public, but offer investors some liquidity along the way. And these are the funds that we're seeing the most issues with. We've seen withdrawals and redemption requests from firms like Blue Owl in the news. We've seen Blackstone in the news recently, even BlackRock. So it's not just one firm that's being hit, it's sort of across the board. It has been interesting to see how these firms have been responding to this in terms of, this really being driven by investor sentiment around the space and just that fear of like what could happen if AI, just eats up all the software and, those companies aren't worth as much because of AI, right? And that's a whole other debate. But at the
Right.
same time, this is driven by a stress to liquidity and sort of investors asking for their money back sooner rather than later. What we've seen is a different approach by all these different fund managers. Like Blue Owl decided to sell assets. They were able to sell a ton of assets north of $1 billion at par, meaning investors were able to get their money back. But they're still facing sort of north of their traditional 5% redemption request limits. Um, BlackRock has decided to cap and sort of say cap their 5% limits and say we're going to stick to it and we're not going to go beyond it. You've seen Blackstone come out and say, raise money internally from their principals at Blackstone to help pay back north of that 5% to investors, saying, look, we believe in our funds and what we're invested in, and we don't think there's an issue. Here's a vote of confidence. We're gonna allow for more than 5% redemptions, and we're gonna put our own money at stake. So I think you've seen a number of these different approaches being taken by these asset managers. at a time where there is some stress and there's some questions around what's going to happen to these software stocks. We're seeing it play out in public markets. You don't really see exactly how this is impacting private markets, but now we're hearing more of it because of these semi-liquid funds. So I think it's something to keep an eye on in terms of just how this plays out over time. Do investors continue pushing for more redemptions? Do we see sort of a slowdown in activity in that space? The semi-liquid space has grown tremendously over the last couple of years. And so, does this event sort of slow that down a bit? I could probably see that coming in terms of just the investor appetite for these types of funds going forward. But we haven't yet seen the uptick in defaults. So at the end of the day, this has not been driven by sort of a credit crisis in the natural sense. I think a lot of people are looking at this as if, is it a corollary to 2008 and subprime crisis? Is this something where there's huge contagion risk across the board? It doesn't seem that way today, but only time will tell, I think, in terms of like the size and scope and how deep this is. I think because we haven't seen the credit side of this change as much, to me, it doesn't seem like that yet. I think you could look at public credit markets and just see, like, looking at these yields here, this is corporate bond yields at different sort of below investment grade credit ratings, and you could see what they've done during different crisis periods. We are nowhere near any of those levels. And I would expect if this was an environment where there was a massive contagion, over leverage, a lot of risk across the entire system, and including banks, like, you would see signs in credit. And we're just not seeing that yet. So remains to be seen, but something that I think is worth keeping an eye on.
Yeah, sure. And interesting to see, how interest rates play into that, whole world too.
Yeah, it'll have an impact. It'll definitely have an impact.
Yeah. Okay, so bringing it back to high level, amidst all of what we've talked about, the war, oil prices, AI related bubble fears, high valuations, I think it's fair for investors, to be skeptical of our ongoing vice, kind of the general ongoing vice to stay the course, right, in their portfolios. So how can we put all of these market impacts and these current headlines into context a little bit? And what's your advice to clients feeling uneasy about where the rest of this year is headed?
Yeah, it's a good question. I'd love to hear your thoughts on this too, Sarah. I think for me, anytime there are these bouts of sort of geopolitical risk, it is good to see, sort of the long term. Typically, things always go back to fundamentals in earnings. I know it's easier said than done to focus on that, but it does matter. And, this chart shows, one of the best data points I think you can see in terms of what happens when you have this type of volatility for an investor who, what we're looking at here is an investor who exit the market after it's down 2% and gets back in afterwards. If you waited 1 week after, 2 weeks after, 1 month after, versus just staying invested, here's what the difference in returns would be. And you're sort of getting cut in half if you wait like a week or more to get back in. And so you can also think about this in the context of putting money to work.
Yeah.
So if you're on the sidelines and this is making you feel uneasy, what you don't want to do is wait around. Waiting is typically not a good strategy. I think, over the last couple of weeks, that for one of the first charts we looked at was showing how the US hasn't sold off as much as international markets. Emerging markets were down a lot more. South Korea actually faced one of its biggest drawdowns since the 90s in a single day after this war started, and only immediately to have its second best day the day after. And so usually those periods of really good strength come after periods that are extremely volatile. Only to say missing those days can be very costly over the long term. So do what you can to stay diversified. That's going to be sort of one of the best ways to handle an environment like this when you don't know what policy decision is coming next. You don't know which way markets are going to go. Remain diversified, but don't remain paralyzed. Try to keep investing along with your plan. That'd be the best advice I could give. I'm curious, Sarah, to hear your thoughts on how your conversations have been going with clients as well.
Yeah, I mean, I think it's the trick is to separate what we talked about in that short-term volatility with long-term goals and long-term portfolio construction, right? Because we have slides like this that show us if you miss the best day in the market, you lose real growth in the portfolio. I think the partner to this slide is the one that shows in a typical year, you can have a 5% pullback, a 10% pullback, and still have real gains in the market by the end of the year, right? I think in 2025, we saw the market pull back 5% six times, and the market still ended the year up 18%. So
Yeah.
it's removing that short-term investor anxiety and remembering that you can still have real growth in a year. And if we've done our job correctly with a diversified portfolio and really creating the right mix of equities to bonds for each client, then the time to make changes is not in the midst of volatility, right? It's to weather those storms, so that you're not selling equities at a loss or missing the best days in the market. But not to say that's an easy thing to do when you're reading the headlines and you're seeing the volatility. So keep asking us, your advisors, for if you have questions or if you're seeing something that doesn't make sense. But the long term view is where we'll always anchor.
Yep. Love that.
Let's see. I think I'm just looking at the Q&A. I think we've touched on everything, and we're at time. So who's to say what will come in the next month, but we'll be back in a month with the next monthly market webinar. Thanks so
Of
much
course.
for your time, Ankur.
Thanks, Sarah. Thanks everyone for joining, and happy St. Patrick's Day.
Bye.
Take care.